Okay, so in this video, I'm going to discuss risk management in international finance. Specifically, we want to look at some tools widely used in international finance. And these tools are mainly dealing with derivatives such as options, forwards, and futures. So first, let's look at options. Options are contracts that give the owner the right, but not the obligation. So basically, if the options are out of money at expiration, then the owner just can let it go and let it expire. And there's no obligation as to you have to buy the underlying stock or asset. So this is essential, okay? That's why we call it an option. And it could be buy something or sell something. If it's a buy, it's call option. If it's a sell, the right to sell is a put option. And the specified price is what we call the strike price. And the date, specified date, is what we call expiration date. So buying a call option means you are taking a long position. That gives you a right, but not the obligation to buy a specific security at a specific price within the specific time. And you have the right to call the stock away. So basically, the reason you are buying call options is because you think there is a upside potential. So the security prices are expected to go up. And instead of buying the security, lock up a big chunk of your money, you could just use call options. Alternatively, if the company is planning to set up a plant in a foreign country, and you are still in the negotiation stage, you are not sure yet. So instead of using forward contracts or futures contract to lock the exchange rate, you could just use options, because these options are flexible and the outright spending so it is smaller. So now buying the put option means that you think there's a downward risk, so you are going to hedge that with a put option. So the understanding the profit and loss is very important. It's very important. So be sure to know how to draw these diagrams. And taking a long position, for example, this is taking a long position for a stock, for example. If the stock price, is equal to the strike price at that point, or if you are just buying this stock, for example, you buy GameStop, okay, at $300. So if the price goes up to 310, you have a gain. If it goes to 250, you have a loss, or below 300, so below your purchase price. So that's the long position. Go up, you win. Go down, you lose. And the short position is the opposite. If the price goes down, you win. Goes up, you lose. So the x-axis here is the price. Okay, that's the price. Okay. Now that's the underlying asset with a call option. So if you buy a call option, you have to pay that premium, and that premium is basically the call price. Okay, and you put up, let's say, $1,000. Okay, if the price goes up to that point, you break even. Otherwise, if it continue to go higher, you'll have a good profit. And the profit, you can see, it can be sky high, unlimited. However, if you are selling a call option, which is taking the opposite side of buying a call, then your loss could be unlimited. So that is a short position when you are selling. So usually, you have to meet certain requirements in order to be able to write the call options or write put options. And this buying a put option is taking a long position. You are expecting the price to drop. If the price decline, your potential, your profit is pretty good. If the price goes up, the most you lose is your option premium paid to buy the put options. So understanding these charts are very important. Understand at what scenario you have a gain, what scenario you have a loss. Then you can use this to hedge your transactions. So let's say the call options provide a flexible hedge against the downside while preserving the upside potential. So you can see that even goes down a lot, the most you lose is only this much. And we could use call options to hedge foreign currency payables. And we buy calls on the currency. If the currency goes up in value, then the call option basically will be in the money, will be making money off the call options. Instead of selling the call options at a profit, we could exercise the call options to buy the currency at that exercise price, because the exercise price, if it's below the spot rate, then you have a gain. So we need to visualize these concepts and visualize the gain and losses. So we are going to do that in a moment. So that's hedging the currency payables. We need to pay the foreign currency. So we buy call options because it's a payable. We are short. Whenever we are short in the foreign currency, we want to take a long position. Whereas hedge a foreign currency receivable, we could buy put options. So now let's take a look at this together. Suppose the forward exchange rate is $1.5 per pound. If importer owes, that's a payable, right? That's a payable. Does not hedge. If you do not hedge, then if you have to pay this pound, right? So if it goes up, you are going to lose, right? Because you are going to pay more dollars if the exchange rate. If it goes down, then you have a gain. So that's unhedged. So if currency rate goes up, you have a loss. And you fear that the currency rate is going to go up in value, then your loss could be unlimited. So you want to, this is your risk, right? The risk is the chance you are going to lose money. So how do we hedge this risk? So basically, we want to choose something having this kind of a payoff. If we have this kind of payoff, that profit can offset this loss, then it's hedged. So if the currency value goes down, you have a profit. Goes up, you have a loss. So now let's take a long position, long call position, buy call options on this 100 million pound contract. And suppose we have an exercise price of this much, exercise price. Okay, so that's a strike price, and we pay 5 pennies a nickel. So in another word, it has to be exchange rate move up to 1.55, or we'll break even, right? Break even, because we paid this 5 pennies to buy the call option. So if the exchange rate goes up in value, you have unlimited gain, right? And this gain can easily offset your losses if you don't hedge. You have your payables right there, right? So that's what we are hedging. Once we hedged, this gain and losses offset each other, then our hedged position, no matter how far this exchange rate goes, our hedged position is 0. No gain, no loss. If there is no gain, no loss, then there is no risk, and we essentially hedged the position. So I've already overlapped these two. So the green one is unhedged, the blue one is hedged. And these two positions, if you overlap these two together, that's our hedged position, is a red curve. You see, the most we'll lose is the option premium, most of our loss, no matter how far the exchange rate goes up. And we could hedge with forwards and futures, but with those, we lost this profit potential. So if the exchange rate somehow goes downward, the foreign currency depreciates in value, then we still retain the profit potential. See, if it goes down to $1.2 per pound, then we still have the loss. Although the loss, the profit will be a little bit smaller because we paid $5 million to buy the call options. So it will be 25 million instead of 30 million if you don't hedge. So the profit is a little bit smaller, but if it goes up, the exchange rate, our loss, if it goes to 1.8 versus 1.5, our loss is 30 million if we don't hedge. Whereas if we hedged, our maximum loss is the option premium we paid $5 million. So we will never lose over $5 million. So that's the beauty of option market hedge. So preserve this profit potential and offer some limit in losses. It's similar to an insurance policy you can see here. So importers who owe foreign currency should buy call options, and who is going to take foreign currency, you should buy put options. If you owe, you buy. If you own, you sell. So that's how you hedge. So importers typically use call options. Exporters typically use put options. So those are kind of option trading strategies as well. Because if you expect the value is going up, you use call options. You can, when the price goes up, you can exercise the call options and preserve that upside potential, and your gain is virtually unlimited. Of course, so once you use this to hedge, that can offset your unlimited loss. And we can do better. We could do better with more complex trading strategies. So the put options will be just opposite of call options. Basically, the importer will use. And if you do not hedge that receivable because you own that receivable, own that foreign currency, you are going to take that. So if the exchange rate goes up, you profit, you have. If the exchange rate goes down, you lose value. And we could use a long put option to limit our loss on this side, you see. And this green curve is our hedged. So the maximum we are going to lose is 50K instead of 2 million potentially. So the importer could buy put options to protect the dollar value of the receivables. And you can see this hedged receivable is similar to a put option, to a call option. So basically, this is a account receivable. Right? In foreign currencies. And if you use this plus the put option, this essentially translates into a call on foreign currency. Okay, don't be confused. Okay. And we could hedge imports with call options, hedge exports with put options. So we could also hedge using the forward market. Say we have this currency forward. So if you use the forward contract, it goes up in value, you gain. If the exchange rate goes down in value, you lose. So that's a payoff for the long position in the forward contract. So this is a payoff, okay? Payoff chart. And these payoff charts are very important. In international finance and derivatives, you must have a very solid grasp of the payoff charts. And most of these are very simple lines, just going up, going down, or just a curved line, like with a kinked line. So you can see this long currency forward together with this unhedged payable will perfectly offset each other. So you eliminate all of the risks, and you eliminated your profit potential as well. So you are fully hedged. So this line, horizontal line, is your hedged position with the forward contract. And forward contracts are used, are the most used in the foreign exchange market here to hedge the payables, because you just get rid of the risk essentially, and also you don't need to you can customize the contract as well. So basically, the hedge fixed the dollar value. No matter exchange rate goes up or down in value, you don't have profit or loss, and you are this is riskless unless the counterparty defaults. The counterparties are typically big investment banks, and they rarely break. And importers could use call options, as we discussed, to hedge this. So this profit and loss offset each other. So that's how a hedged position. So the difference of hedging using forward contracts versus call options. Using forward contracts, basically you hedge both the downside and upside, and call options preserve your profit potential. Whereas the call option, the drawback is you have to pony up this call premium. Whereas these forward contracts, there is no premium involved. It's zero value. Okay, so basically you don't need to put up any money. So the profit or loss just fluctuate with this exchange rate movement, but you don't need to worry about those. It's just like you go to a mortgage broker, you locked the interest rate, so it's locked. So essentially you locked the exchange rate. And the importer could buy call options to protect against the appreciation of pounds, to protect the payables. And we could take it to a higher level. Some of the importers could absorb certain risks. So they want to keep both the upside and downside profit. So if there are wild movements, they hope they can make a profit. So this is our hedged position, right? Synthetic put. So because the reason we call it a synthetic put, this is really two positions. A unhedged payable and a call option. Together, we synthesized this put option. And can we do something like this? We don't mind to lose a little, but if it goes up in value, let's have a profit. And whenever it goes down big time, we gain. Goes up big time, we gain. If we just stays right there, we just lose a little. So, and we can afford to lose that. So can we engineer some kind of financial instruments to have this pay off? So the beauty of financial engineering is you could, as long as you draw up the payoff chart, you could find instruments to synthesize, to combine those instruments to achieve your goal. So essentially, with the green synthetic put, if we buy a second call option, you see you have the upside potential right there. So together, it's what we call a straddle. So this straddle has three things there. A unhedged position in foreign currency payables, a call option, and a second call option. And the payoff chart is this V-shaped. V-shaped. It's a straddle type. Okay, so if it goes up big time, goes down big time, you win. If it doesn't move a lot, then you lose the option premiums. And suppose the importer is willing to risk large exchange rate changes, but wants to profit from smaller changes. So we want to have some kind of profit right there. And if it goes up big time, goes down big time, we'll have some kind of loss right there. We want to limit there. So if the exchange rate doesn't move a lot, we have a profit. If it moves wildly, we'll just protect it with this option premium. And this is what we call a butterfly. Can we do something like that? So we basically buy a second put option. You see, this put option started when we have a loss there, we started to have a gain there. And if we overlap, and then we sell a put option, two puts, and see, we have a gain in this range. We have a gain in this range, this blue line and a green line. And these gains will combine themselves and form a profit. So that's our profit. It's a red curve, and it's like a butterfly. So this is what we call a butterfly spread. So basically, we engineered with call options, we engineered this certain payoff. So as long as you can imagine the payoff charts, the scenarios, then you can find instruments or financial instruments to make it happen. So a motivated financial engineer can create almost any risk-return profile that the company may wish to consider. And these straddles and butterflies are very, very commonly used. Now, next we talk about forwards and futures. So a forward contract is a private agreement. That means you cannot trade. Over the counter means customized. Whereas futures contracts are standardized. So futures are traded on exchanges. So they are traded and standardized. And some students, if they trade futures, they'll notice there's no money exchanged. However, there's an initial margin required as a guarantee. We'll talk about the initial margin and maintenance margin in a little bit, and we'll go through an example. So there are reasons that they have this standardization of this forward contracts into futures, and the main features are contract size and the method of stating the exchange rate, maturity date, etc. The settlement And these are common to most of the futures contracts. Later we will talk about commodity futures, interest rate futures, stock futures, and these are quite similar in the standardization process. And these are the major differences between forwards and futures. Customized versus standardized. Okay. Private versus you can trade. Okay, you can trade. You can trade. And forward contracts are customized, so it's hard to reverse. And the profit or loss will be realized on the delivery date, whereas futures market is called a marked to market. We'll talk about a marked to market in a little while. And futures require margins, and there are two margins: initial margin and maintenance margin, whereas a forward only set once. Futures contract, there's an initial margin when you first enter the contract, and there's a notional value or the contract size. Sometimes you may notice, you suppose the contract size is $100,000. That's the size. Okay. Suppose you bought 50 contracts, so the notional value would be 5 million. That's a notional value. Whereas if it goes up or down in price, suppose goes from $1.06 per pound to $1.07 per pound. Okay, suppose that's the case. Okay, of course that is the contract size would be in pounds, but we'll talk more about that. Okay, and then you have a gain, and if you have a gain, then you multiply this and also multiply by the contract size. Let's look at that. So suppose one contract of British pounds, and the contract size is this much, and you don't have to have that much money in your account to buy this contract. The initial margin is as long as you have this much money in your account, then you can buy one contract. You can handle this much. Okay, that's using this initial margin account of only $1,000. You can trade on 62,000 pounds. That is a leverage. That's a huge leverage. Leverage means risk. It's very risky. And suppose the maintenance margin is 800. The next day, the futures price drop. You are going to have a loss. Just drop only a penny. See, only 1 penny drop. But since you have a contract of this large, how much do you lose? You lose 1 penny times this would be $6.25, right, per pound. So you lose 1 penny per pound. So for the whole contract, you lose $6.25. So you lost this much, taking away from the 10,000 over 650, and your value drops to 430. Your account value, and that is below the maintenance margin 800. Then you get a margin call. Yes. How much? You have to bring this account value all the way to the initial margin. That means you have to put up 650 in order to bring this whole value to the initial margin. This is 650 there. And then on the third day, the price goes up, then you are going to have a gain. So what is your gain? And then you can find the account balance. So here's okay. So let's look at okay. So let's look at the answer on this one. Okay. So day 0. Okay, day 0. So your balance is 1080. Your position is one contract. Okay, one contract. So you bought one contract. Okay. You are long. Okay, you're long. Okay, long on pound. So if the pound price exchange rate goes up, you gain. If it goes down, you lose. And the exchange rate is 1.625 or 635 per pound. Okay, and then the day one. Okay, the profit or loss is we lose 650, and the balance becomes 430. Okay, and then you get a margin call. Okay, margin call. So you fill up this tank all the way. So you have to this transaction is you have to so transfer 650 to the account. So that's a deposit. Okay, and then bring this balance all the way to 1080. And suppose day 2 the exchange rate did not move. So the day 2 your account balance will stay at this much. And then the day 3 you, let's say, goes to 164. So if it goes to 164, it's from 1.625 goes to 164. So the difference is so it's going up by 0.015. That's a dollar per pound. And your position is one contract. You multiply by 625. Okay, sorry. I think I made a mistake right there. So it should be 625. So this should be 625. Okay. Where is it? So you lost 625 here. So you put in 625. Okay. So this is not 430. It's 455. Okay. Okay. 455. Okay. So this is a 455. You deposit 625 to make it 1080. And the third day your profit is this much. Okay. So 625 and half of that 625 is basically 312.5. So that's the total profit. That's for that penny. That's half a penny, right? Together is equal to 937.5. So that's your profit, right? And that profit will be added to your account. So you have a gain 937.5. That gain is added to your account. So it becomes over 1100 now. So essentially you had a overall you had a gain. And here's the answer. Okay, here's the answer. So with your gain 937.5, your account balance would be 2017.5. Okay, so 2017.5. Okay, these two together. Okay, so that's how this margin call and the mark to market works. So every day, so the gain or losses will be reflected in your account. The mark to market implies that a potential loss or profit are immediately realized every day. And the futures contract rarely take a physical delivery, but it does happen about 5% of time, or maybe 1% of time. It's very rare, very rare. Okay, but when it does happen, it's quite risky. Here's one example: a big sugar delivery fulfills a futures contract because the trader just want to get that sugar. You could type this up in Google and search on this. And there are other types of futures contract, like currencies. It's very liquid. And commodities. And these are very useful for farmers, for example, and speculators, and for investors to hedge against these commodity prices. So essentially, you can use these futures to basically lock in your price. Stock futures, interest rate futures. And to use these forward and futures contracts, essentially, we either do a long hedge or short hedge. A long hedge basically involves buying the futures contract in anticipation of the spot purchase. So basically, you are going to exchange dollar into pound. So you want to lock that exchange rate so that you buy the futures contract. And shorter hedge is kind of opposite. So if you are going to owe in the future, you take a long position. If you are going to receive, you take a short position. And this is very important. You need to understand this how to hedge. So you owe foreign currency, you take a long position, you buy. If you are going to receive, you take a short position, you sell. And suppose you are US importer, you need to pay pounds, right? So you owe. If you owe, you want to buy. And if you buy, that means that you take a long position, a long forward contract, or long futures contract. So that's a hedge with buying or long forward. That means in pound. So you lock that exchange rate so that you basically you get rid of the risks, foreign currency risks. So take a long forward contract. And here's the payoff, okay? So if you don't hedge, your potential loss is huge. And the foreign currency exchange rates fluctuate a lot. So you could have unbearable losses. Whereas if you hedge with a forward contract, if you do hedge with long forward contract, so you buy forward contract, that's your payoff. Combined with the unhedged payable, you see they perfectly offset each other. So you have a straight line, horizontal. So it's perfectly hedged. That means you eliminated the exchange rate movement risk. And understanding this profit charts, payoff chart, is very important. Long going upward, short positions going downward. This is the last slide. So there are two major questions must be answered when you are trying to hedge. So what kind of contract should I use? Forward, futures, or options? Or later on, maybe talk about swaps. Once you pick contracts or combination of contracts, then how much? How many? Okay, so these are the things you need to pay attention to, the essential questions. And thank you for watching this video. I hope you enjoyed it. Let me know if you have any comments.